It seemed impossible. Back in 2012, no one on the street would have bet on this. Yet, it's happened. Italy has overtaken the UK in GDP per capita for the first time in 2 decades. As of August 2025, World Bank data shows Italy at $60,847, just ahead of the UK's $60,620, adjusted for purchasing power parity. It's not a World Cup blowout, and sure, Italy might fudge its GDP numbers like a pizza recipe, but the truth is undeniable. The UK is slipping. Cities are unaffordable, public services are crumbling, and economic growth? It's as mythical as Excalibur. Worse, fewer Brits believe things will improve. Keir Starmer stepped into 10 Downing Street promising pragmatic reforms, fiscal discipline, and deregulation in energy and housing. He sounded almost Thatcherite for a Labour leader. But governing isn't as simple as opposition promises. UK markets are sliding as debt fears push 30-year gilt yields to 5.723% in early September 2025, a level not seen since 1998. The situation was already dire, and then, boom, public debt exploded, making everything worse. So, what's going on in the UK? Why is the debt skyrocketing? And what does it mean for Starmer's promised reforms? We're breaking it down, but first, a quick gift. In the QR code and description link, you'll find a free financial profile quiz from the Visual Factory Club. It'll show you your investor type based on your situation, goals, and risk tolerance, what assets fit, mistakes to avoid, and how to optimize savings. We send free financial tools weekly at the Visual Factory Club. Scan the code or click the link to check it out. Now, back to the video. To get the mess, let's rewind. Rachel Reeves, the new Chancellor, hasn't forgotten Liz Truss's downfall. Post Boris Johnson, Truss aimed to transform the UK into the Singapore of the Thames. Brexit was a mess, but her plan? Massive tax cuts without touching spending. Markets panicked. Debt yields spiked 50 basis points in one day, a disaster. Truss lasted 44 days, shorter than a summer romance. Why mention this? First, it shows how bad things are now. Under Starmer, yields have risen 100 basis points, double Truss's spike. Her crisis was a blast. This is a slow burn, but the ending could be just as grim. UK gilt yields are breaking records with no signs of stopping. Second, Truss's failure births Starmer's golden rule. Current spending comes from taxes, not borrowing, within 5 years max. Long-term debt is for investment only. Sounds sensible, but delivering? That's tougher than Hercules' labors. The NHS and pensions eat up the budget, leaving little room. They're untouchable, too. The triple lock guarantees pensions rise with the highest of inflation, wage growth, or 2.5%, a pensioner's shield, a fiscal nightmare. But that's not Starmer's only headache. Personal independence payments, disability benefits, are ballooning. A broader disability definition and an aging population mean costs jumped from under £5 billion in 2016 to a projected £40 billion by 2030, 8 times more in 14 years. Starmer, a Labour PM, suggested cutting £5 billion, 20% of the total. The result? 124 of 165 Labour MPs revolted. They settled on cuts for new claimants only, sparing current recipients. A similar fight happened with winter fuel payments, subsidies for pensioners' heating bills, pricier than ever in the UK's costly energy market. This also explains stagnant per capita GDP. Here's a key point: bond yields tie to default risk. No, the UK isn't Argentina, but there's another way to pay debt: inflation. Promise £1,000 in 30 years, but if it's worth monopoly money by then, investors lose. The more the budget spirals, the more markets fear inflation, demanding higher yields. It's a vicious cycle: debt rises, interest climbs, eats the budget, debt grows. Another fix? Raise taxes. But Starmer's popularity is tanking. Polls show him trailing Nigel Farage's Reform UK. Tax hikes don't win votes. The government insists no new taxes for regular folks, but how to fix it? They're vague, and uncertainty fuels debt, slashing Reeves's wiggle room under rules requiring tax-funded daily spending by Parliament's end, down to £4 billion from £9.9 billion. A wealth tax is one idea: hit the rich harder. But the wealthy are bolting faster than Harry and Meghan to California. Those staying, often boomers, guard pensions with the triple lock and vote heavily. Taxing them is tough. Another option: tax banks. But customers, regular Brits, would likely foot much of the bill. Banking's already taxed hard, and more could hurt London's global edge. Then there's fiscal drag, not adjusting income tax bands for inflation. Higher nominal salaries push people into higher tax brackets, even if buying power drops. UK tax bans are frozen until 2028. Keeping them frozen could net £8 billion extra, per studies. Will they update in 2028 or forget? Your guess, the harsh truth? The UK's tax burden is at post-war highs. Squeezing the rich more is nearly impossible. More revenue means hitting the middle class, again. The question isn't who has more, but who pays, a fair split or a burden on the young. The government's got massive spending but fewer ways to fund it. Investors, fearing inflation to dilute debt, demand higher yields. Two players amplify this: pension funds and the Bank of England. Pension funds once gorged on UK debt but now chase better returns globally. Why? A shift from defined benefit plans, guaranteed payouts, to pot-style plans where you save, invest, and withdraw. These funds don't commit, reducing debt demand, pushing up yields. The Bank of England's also buying less debt to clean its balance sheet for future crises. But it's not just the UK. Global debt costs are soaring. Japan's bond yields hit multi-decade highs. France and Germany see 14-year peaks. Why? Too much public debt, too few buyers. In 2023, OECD nations issued $14 trillion in bonds, 2025's at $17 trillion. With trade wars and geopolitical chaos, investor appetite's low. Many thought a weaker dollar would boost euro or pound bonds. Nope. Markets distrust the US and Europe alike. Gold's winning instead. Another theory for UK debt costs? The economy's heating up. In 2025's first half, the UK led the G7, outpacing the US. Some say markets expect high rates to curb 3.7% inflation. But it's not overheating. Public spending on housing, renewables, and grids is juicing GDP without immediate returns. Back to the core issue: spending outstrips revenue. Not all's bleak. The UK set a record in a 10-year bond sale, with high yields drawing demand 3 times the supply. Starmer placed £14 billion in one auction. But yields keep rising. Why? Other nations offer juicy rates, too. Lower them, and investors might flock to French bonds. No easy fixes. Starmer must balance the budget fast, or future interest payments balloon. Who pays the price? That's the question. Your turn. Is Starmer handling the economy better or worse than Truss? Can the UK tame this debt surge? Cut spending or raise taxes? Drop your thoughts below. If you liked this, hit thumbs up, and we'll see you soon. Cheers.